We're back. What's up, Jim?
Good to see
Nice to
you,
see
my
you too,
friend.
buddy.
Happy, what is it, Wednesday? Yeah.
It's Wednesday,
So I just
man.
got off the
And
golf course. I just got off the golf course here. It's just a photo actually, but I'm actually at a golf course in honor of Augusta. There's a big golf tournament this weekend where a lot of people go watch people golf. No cell phones. You can't talk, but you get to drink a lot of alcohol. So I don't know. Might be a good event, maybe not be. So
all right. I like that. I like that. And then
it was,
obviously, mortgage rates are still in the middle with what's happening with Iran and the US and Israel. But I have a question about deregulation because it'll matter longer term. So the White House came out and said we want to remove a lot of the red tape federally from building homes and just the process is expensive. I think they said it was like $100,000 that were unnecessary in order to build a brand new home, right? Now, I'm assuming they're going with the average priced home. But that's a lot of money, man. So here's where I don't have an answer, and I'm going to you on this. The federal government saying let's deregulate red tape and all that. The state still has to agree to all of it, whatever it is. How does this affect mortgages? How does this affect your world? Does it or does it not? Because you're also building right now.
Yeah, so actually, yes, as a builder, it's a good thing. I'll talk about the builder side first. I actually live in California. In my county, you have to have 139 signatures, sign-offs before you can start building a home. 139. It's crazy, right? So it takes a very long time. A lot of
Wow.
bureaucracy, a lot of agencies, if it's the EPA or if it's some other agency, a water district, whatever it might be. So less bureaucracy is good for speeding up the process. Hopefully, it does not create a less quality project or a a safety concern. So that's the part of the building side. It should speed up the momentum and the appetite for building. If builders can save money, they might build a lower price point because remember,
Hmm.
builders get paid a margin on what they build. So if you already have
Yeah, of
$100,000 built into the just to get permits, you're not going to build a $200,000 condo. You're going to be building $1 million home to make that margin up.
course.
So this should make the barrier to entry go down for a new first time home buyer or move up buyer or new product, which is great.
Okay. I like that.
From a
Now,
perspective, oh, sorry, go ahead.
and now what, well, on the mortgage side, give it to me there.
Yeah, so from a perspective of regulation or deregulation on a mortgage product, deregulation normally means a loosening of guidelines, a loosening of qualifying income parameters. It's going to free up people maybe that were on the fence of qualifying to be able to qualify. What it won't do is lower the interest rates. It will purely give a broader scope as to how to qualify a borrower. Ironically, that wider qualifying parameter might actually make rates go higher. Because if you're willing to be able to legally take risk on a lower credit score now, or maybe a no income qualifying loan, those are riskier loans. So, what it will do is be able to serve more people, but it won't mean that rates go lower from that activity.
Got it. Okay. Now talk to me about one other thing that I was reading that is not in my world, it's in your world. So it looks like they're part of the deregulation process that's happening is also happening with big banks. So Wells Fargo, um, Chase, Bank of America, for the longest time since the big recession, oh 08, 9, 10. That whole debacle. A lot of these big banks stopped lending um, to us, the homeowners, and then you saw Rocket blow up because of it, and all these other companies grow into it. Now, because of the deregulation process, a part of it, now they're able to lend again because of whatever happened. And this is part that I'm not clear on. What happened and why are they going to be able to lend to the consumer more? Do you know?
I do. So remember, there was in 2008 there was a bank foreclosure meter, bank blow up meter, where banks were going out left and right. Banks are
Yes,
supposed to be
yes.
secure. Reason why is they were over leveraged on their balance sheet in non-performing assets. So Washington Mutual, for example, did a lot of their option arm products on their balance sheet. When things started going bad, it spiraled out of control. So the
Mm,
government threw in some benefits and also some governances. So they bailed out people with TARP money. If you remember TARP,
I do
TARP.
remember that. Dude, I
Remember
totally forgot
TARP?
about that.
Yeah, 70 billion bucks, money just getting fed out. What it did in reciprocity for that is they said you have to have a certain ratio of assets on your balance sheet relative to what you lend out. So what happened was there was a stress test initiative that was built in, and that's called Basel 2. And what that is basically is making sure that the stress test is met by very conservative standards so that we didn't see what happened in 2008 happen again. So now that
Oh,
things have normalized, the regulators are trying to say, hey, we don't need to be as constringent or restrictive on this stuff. Let's loosen things up so they can lend more of their balance sheet. So that's part of that deal where normally you have to have about 10% on your balance sheet of the money you're blending out.
and how do you see it? Do you think it's a good thing overall, or do you think it could create a problem in the future again?
It could create another problem. The category I'm most concerned about is DSCR loans, debt service coverage ratio loans,
And why?
which is basically like a stated rental income. It's a stated rental income program for the most part. So I have a renter in my
Oh,
property. I'm qualifying off that up to 100% of that payment. So if I have a $4,000 renter, I can use $4,000 of overall payment. But what happens if the market goes down or we go into recession or there's more housing available at that same price point to buy versus rent? Those rents are going to go down, and therefore those owners are not going to be able to afford the payment because they've already had 100% debt service coverage ratio, which means every dollar they bring in is going into that payment, not for improvements, not for upgrades, not for vacancy factors. And that's a scary category. I don't focus a lot on DSCR loans because it reminds me a lot of certain companies' strategies in 2006, 7, and 8, which were
I
not
remember
really
that.
effective. So I think there'll be some challenges. I do like the regulation that has made it harder to qualify and be stronger for the consumer to disclose information. So I'm happy that there are protections in place to educate consumers, but I am a little worried about some of these exotic products that come along pretty fast, and then if a market moves, it could really affect those homeowners.
Are any of those products that are bank statement type loans, do any of those fall into the DSCR loan category?
Yeah, DSCR is for rental properties, so it could.
Got it.
But
Okay.
bank statement loans, ironically, bank statement loans are not bad. Stated income loans are bad. Bank statement
Got it.
loans show revenue coming in the door, right? Or the propensity for someone to be able to make the payments. Stated income means I'm going to just like a driver's license. I'm going to tell you that I'm 6'8", 180 pounds, blonde hair, blue eyes, and that's my profile, right?
Those
Not
sound
real,
great to me. I
not
don't know what you're talking about. Those are great.
not reality. So stated income is bad in my opinion. Bank statement or alternative documentation is awesome. It's a good way of qualifying. So,
Got it. Yeah, I know a lot of entrepreneurs qualify through that route. So, dude, I
yeah.
like that. All right. So, last thing then, if we continue to see challenges in the Middle East or anywhere else because we're involved in them as a country, where does that leave us for mortgages? Because on the real estate side, you saw what happened. The reports came out. We are 3.5% less sales year over year in the United States then we were already at 4.1 million. Now we're under 4 million, right? I mean, dude, what nothing's selling in comparison to what we normally
Yeah.
do. So where does that leave us on the mortgage side?
Yep. I see two factors. The anchoring effect, right? Someone's not really willing to sell their property if their rate's at 3% and rates keep climbing higher, right? The higher the rates go above 6%, the less likely someone is wanting to move. The other part is that if you don't have to make a decision right now, there are a lot of factors that are confusing. War, economy, am I going to have a job? Is AI going to take over my life? All those factors. So people have
Yes.
kind of put themselves on the sidelines to see how the chips are going to fall. So I look at this as a great opportunity to go in with a lower offer if I'm a buyer, ask for the world. It doesn't hurt. There's no cost to do an offer, And I'm seeing on average between 2 and 4% credit back for buyers. If it's buying the rate lower, if it's getting credit towards closing costs or getting some improvement done. So why not do this now when everyone's going this way, go that way and see if you can get
I
something
like
as
it.
long as you have a good long-term plan.
Okay, I like it, man. Thanks for doing this. Jim, again, see you next week. I'll probably see you before that, but for this, see you
I'm
next
sure I
week.
will. Thanks, pal. Take care,
Thanks,
everybody.
everybody.